John Cleaver, partner, senior financial advisor at Beyond Wealth Advisors, and with me again this month, Dennis Bacon, Chief Investment Officer. We're back for our mid-year, believe it or not, the year's half over, our July economic update. Last month, we talked about inflation and the impact that inflation is going to have. This month, we're going to shift just a little bit and talk about what does that mean for economic growth in the second half of the year. So take it away.
Well, I guess as we went through this year, we started out the year hoping we would have growth. And over the course of the year, we've kept having upward revisions on what they think the growth factors will be for this year. Now remember, at the end of 2020, we recovered a lot of what we lost during the initial part of the pandemic. But we're actually projecting a growth increase in gross domestic product, hard to say sometimes, of about 6.2%, which will be one of the highest growth factors we've had in years on just a straight year. Also projecting in 2022 that we'll have about another 4% growth, if not a little bit more. And those revisions keep getting bumped up, so we may even see higher revisions going forward. If we get up to 7 or 8%, it could be the highest we've had in 30 or 40 years.
What's causing some of those bumps? Where do you see that coming from?
Consumer spending.
Okay.
It really is all about consumer spending. We have almost $2 trillion of consumer excess disposable income out in the economy right now that has not been spent yet. We are currently looking at people with the highest net worth that they've ever had in their history. We're also at a post-pandemic high in consumer confidence, which is really crazy considering where things were a year ago. A lot of pent-up demand out there, and there's also a lot going on in the labor market, a lot of pent-up need in the labor market.
Yeah, so you mentioned lots of pent-up spending, great confidence. So talk about the job markets. How is that impacting the job markets? What are you seeing? Kind of a new place we've not been before.
Right. Well, it's been a long time since we've been here. It's probably been back since maybe we came out of the recession of the late 70s. Right now, there's over 9 million job postings in the market right now.
That's not job. That's not people without jobs. That's
people that are openings where they're looking for somebody to hire.
Wow.
Now, the other thing that's really interesting is they call it the quit rate. The quit rate is people who are quitting their jobs to go get a better job is the highest it's ever been in history.
Wow.
So we're seeing a lot of, I think the pandemic has created a lot of people looking at opportunities on where they can do something different. They're going out and looking at these things with some dynamic shifts and changing, maybe companies who aren't as flexible as others. They're just looking at a lot of different things. A lot of people going out and starting their own businesses and stuff like that right now too, which is great for the economy.
Okay. So great for the economy, but can it continue? Can we keep at this pace, and do we want to keep at this pace?
Well, certainly. Are you talking about the economy or the market?
Well, that's a good question. Let's talk about the market first.
Okay. I think in the market side, we are seeing exceptional earnings growth, a lot of really high growth. Rates of 9, 10, 11, 12% growth over the next 2 or 3 years. So that's all the reason why you're seeing the market priced where it is. Usually the market's a year or two ahead of the actual earnings, typically. Those things are really good. There's a strong macro framework in the company. That was founded pre-pandemic, we had a great framework for growth. So that's still supporting the economy right now in a lot of ways. We're seeing a lot of attractive valuation in the stock market versus being in bonds. Bonds still have the risk. We've talked about those. We're not going to belabor that now. As if interest rates rise, it creates a problem in the bond market. We're also seeing, because of all the cash companies have, it becomes a very shareholder-friendly environment. Because you're seeing dividends rise, you're also seeing stock buybacks, and you're also seeing that happen both with some companies because of so much cash. So those things are really good for the economy, for the markets going forward.
For the markets going forward. Yeah. What about the economy?
Well, as we've said, if the consumer drives 70% of the economy. If the consumer's spending money, the economy is good.
Gotcha. All right. To wrap up, there's often some myths that come along with inflation, and that's kind of a topic we've not really been discussing much the last few years, and now that inflation's kind of front and center, you know, one of those myths is that rising interest rates can actually hamper the equity market.
Well, that's actually never been proven to be true. We've never had a situation. Rising interest rates usually happen when the economy is strong, and we're right where we're at today. We typically would see rising interest rates. So that just really is a myth that just has no basis in any reality whatsoever.
Excellent. All right. Another myth is that higher inflation can slow positive returns.
Well, higher inflation is usually a result of more wages and also more spending.
Right.
The reality is, if we go back and look in history over the last 50 or 60 years, that when we've had inflation between 2 to 4%, which is what we're looking at right now, it may be a little higher than that. The average return in the market during all those years where it came between 2 and 4% is about a 13% return. So there really is no evidence of that either. It's just a thought process that isn't based upon reality.
Interesting. Interesting. All right, last one. The myth that the Fed hiking the interest rates has killed the bull market.
Well, there's some bit of truth in that one.
Yeah.
But it's not until we've seen the second or third interest rate hike.
Right. You've only had one, correct?
We really haven't really had any at this point to speak of, not really ones that are systematic.
Right.
And so we really haven't had any. We've had them pare back on some other tools that the Fed has relative to their buying and interest within the credit markets. But the interest rates themselves, we really haven't had much. And it usually is at least a second one before we really see it turn. And by then we already have a situation where the economy has grown really fast anyway.
Right.
So.
Right. Well, that's excellent. Well, thank you for being the myth buster today. And as we look forward to the second half of the year, we invite you to reach out to your advisor and make sure that you're connecting through the summer. Sometimes people get busy and schedules are crazy. Make sure you're connecting with your advisor if you have questions about what's going on. And we look forward to another great next 6 months. And before we know it, we're going to be in 2022.
I know. It's crazy. So anyway, y'all have a great rest of your summer.